everyone, Tom Gentile. Welcome to Tom's Trading Room. Glad to have you here for our next video. We are now in the month of July. I want to take a look at the big picture of July. If you're new with us, welcome. Glad to have you. Show me some love. Give me a thumbs up below. If you subscribe to our videos and hit the bell, you'll be notified every time we upload a new one. Today I'm going to discuss S&P, TLT, UUP, USO, GLD, BTC, an earnings calendar, and something I also call my money calendar and what it has to say for the month of July. Let's go ahead and get started. So this is a chart of the S&P, and as you can see here, we've been channeling up ever since the coronavirus low in March, have been channeling higher, but we're running into some resistance right here in the 317 area. Any close above that, and we could take out those old highs, that island top reversal that occurred at the beginning of June. All right, support is still pegged down here around the 298 area for SPY. TLT looks like this. We've been throttling up on TLT again also since February. Now, you got to take the spikes out that occurred when we had that big barn fire sale that happened with coronavirus. But if you take all that out, we're still creating lower highs and higher highs. All right, highs that occurred at 165, above 170. But lately, we've been kind of chopping down and getting into an area of consolidation. The bond market, in my opinion, has 2 points that it has to face. 168 to the top side. That's where we're seeing channel resistance, and 160 to the downside. That's our first area of channel support. UUP is something I don't typically trade. I just look at it a lot, and I use it to trade other instruments. But UUP has been channeling down since that big binge high when everybody wanted US dollars back in the middle of March. Since then, we've been getting lower and lower lows as well as highs. We dropped out after Memorial Day weekend and went from about 2670 down to a low of below 26 before starting to consolidate. We're actually forming a wedge pattern right now in the US dollar. The US dollar is either going to break above or below. Now, logic would have you say, oh, it's definitely going lower because the government's printing trillions. But this chart is not against commodities. This chart is against foreign currencies. And foreign governments are printing their own trillions. So keep that in mind when you look at this chart. Finally, let's take a look at commodities, and I got a couple of commodities, actually three of them we're going to look at. First is oil. This big S over here is the reverse split that occurred back on April 28th. This happened at $17.50, which is now the low for the year in USO. Currently trading up in the 29 area, all right? I've been saying this for the last couple weeks. Resistance is above 30, support's below 25. If we stay in that area, it's really not a positive or negative for equity traders. We get above it, it's a positive. We go below it, it's a negative. All right? GLD, the safest place that I believe your money can be put, has gotten both the short and long-term channels pointing up. All right? We are knocking on 168 right now, which is the support, and this takes us back to highs we haven't seen in gold since 2012. Right? Gold hit over $1,800 an ounce last week. All right, it nudged it again this week, but again, we have to have some significant closes above $1,800 an ounce to see this move higher. My target on GLD right now is between the 175 and 180 area. All right, 175 to 180 would put us near the $2,000 an ounce mark on the price of gold. Finally, you got Bitcoin here. I put Bitcoin here because there's a signal that just came out on Bitcoin. So Bitcoin was trading back in April around $6,500, went as high as $10,000, not once, not twice, not three times, but nearly four times if you count this little spot right in here, right, before peeling off. But what's been happening that's interesting with Bitcoin is it's creating about a 1,000-point trading range on average. When you see 10,000 or 10K here at the top and 9K just below, right? We just bounced off of 9,000 yesterday, all right? That was Sunday. And we got another buy signal on Bitcoin. However, again, we're looking at about a 10% trading range on this one. So keep your eyes on it. We'll see where it ends up going as we head into the month of July. Earnings. So let's take a look at our Q2 earnings season, which is starting this month. Also, we've got patterns. I want to show you a 10-year history of the month of July using the money calendar and how I compare the two to create opportunities from them. So let's start first with earnings. This is a culmination of earnings that are happening in the month of July. So if you take a look at the first week of July, we've got 15 companies reporting, 7, 11, 13, and 3. That's all the way out to July 10th. Drop down to the second full week of July, and you'll see 3, 10, 34, 57, 22. Again, not that many when you're looking at all optionable stocks. But take a look at what happens on the third full week of July. We start out with 21 companies on July 20th. That jumps to 44, 184, 242, 49, and that trend continues. So if I draw a line in the month, all right, less earnings the first 2 full weeks, which we're in the first week now, more earnings are coming out in the back half of July. This is the bubble. This is when we start to see the sweet spot when most companies start to project earnings and report those earnings. Now, what does this got to do with the money calendar? The money calendar is a calendar that myself and our group created. We actually are in the process of patenting the money calendar. So what the money calendar does is it takes a look at all stocks that are optionable. We look at a minimum of 10 years back. And what we're trying to determine is, are there any patterns between certain days, seasonally? And if it's going to show up on this screen, it has to be 90% or better using a minimum of 10 years data. Well, as you can see, the first full week of July, I've got a lot of green on the screen. That means that most of the patterns, 92 on Monday, 72 on Tuesday, 92, 94, 93, of those patterns that are coming up, the majority of them are bullish. Take a look at July 6th. 99% of the patterns are bullish, only 1% of the patterns are bearish. Now, go take a look at July 20th, just 2 weeks from now. Now we've got 44 trades, 32% are bullish and 68% are bearish. Draw a line right across here. This is when the bulk of earnings are happening down here in this bottom half of the calendar. Am I suggesting, based on 10 years of data, that we've got more bearishness to come because of earnings, because Q2 is soft? Yes, that's exactly what I'm suggesting. No guarantees of what's going to happen, but over the last 10 years, more often than not, companies report softer than normal Q2 earnings, and it shows in the historical prices. All right, let's dive a little deeper. July 6th, the top 10 that I rank based on patterns are all in the green. They're all bullish. Google, Boeing, Netflix, Apple, Chipotle, United Healthcare, etc. These are all patterns where I'm looking at Google. It's a green bullish pattern that goes out 21 days starting on July 6th. Okay, this is great. Look what happens 2 weeks later when we get to July 20th. When I rank the top 10 patterns, again, by how much strength is in the pattern, complete flip-flop. Now we see more bears. 8 of the top 10 of our patterns are bearish. BlackRock, Adobe, Netflix, Veritas, Lam Research, etc. The majority of these are actually bearish. So when you look at the individual stocks, they do fit the bill to what we were looking at on the last screen, which was the actual calendar. Now, the way I trade this is actually very simple. I'll take a look at a pattern like Google, and I'll go in and I'll do a deep dive on it. And I'll say, oh, okay, so buy it between July 6th and August 3rd. Great. The last 10 years, it's netted over 500 points of profit during this 10-year back test. 21 days on average, 50 points average per trade. Maximum drawdown. This is the worst that it did in the last 10 years, as it went against us by 23 points. The best that it did was go in our favor by 166 points. These are all stats that I love to work a trade off of. And then from here, what I'll do is I'll look at some trading opportunities. This is an example looking at the August 7th, 1540 calls. Now, if I were just to buy the August 7th, 1540 calls, I'm going to pay $32, $3,240 for that trade. That's a bit rich. But if I mirror that with the 1540 call by selling the 1550 against it, I'm actually able to do that trade for a little more than $400, not $3,200. That reduces my cost, reduces my risk, reduces my break even, and gives me a lot less stress than the trader that has call options that they just paid $3,200 and change for. All right, on a risk graph, it actually looks like this. So this is not a chart of Google. This is a chart of the trade example that I just gave you. All right, so the trade example, again, what were we doing? We were buying the 1540 calls, all right, B 1540C, and then we were selling, that's the S for sell, the 1550 calls, and being able to do that, not for $32, but for $4.10. Multiply that times 100, and you're talking about a trade that costs $410. All right? The maximum I can lose on that trade, no matter how low Google would go against me, would be what I paid for it. In this case, it's trading around $410 for the contract spread. The most I can make, because if I'm going to buy something and I'm going to sell something against it, then I'm only able to make a certain amount, and then it just goes sideways. No matter how high Google goes, for every dollar I make on the call I bought, I'm going to lose $1 on the one I sold. It's the spread in between where I make my profit. This one has the ability to more than double in profit. In fact, it's closer to 149%. All right, return on risk. But think about this. In order for Google to go up even 100%, it'd have to be trading around $3,000 a share. In order for our trade to go up 100%, we really need to be trading closer to 1550 by expiration. Max risk, the most I can lose on the trade. Max reward is the most I can make on the trade, and break even is actually quite easy to calculate. You take the strike you bought, the 1540, you add on the premium, $4.10. All right, and so now my break even is now not 1540, but 1544.10. That's my break even. Remember, strike price plus premium. All right? Hey guys, remember, in summary, July is just one of those areas where it feels like a melt up. But we might melt up a little bit more based on the data that I've collected and what I'm looking at over the last 10 years. Earnings will really start to take place in the next couple of weeks. And the money calendar, which I showed you, is telling us that these earnings coming up in the next couple of weeks could be quite soft. All right? Hey, again, thanks for joining me, everyone. If you like this video, give me a thumbs up below, subscribe to our videos, hit the bell, and you will get a notification each time I upload a new video. We'll talk to you soon. Bye now.